Hi students, this is Mr. Jason, and now we are actually going to cover the final chapter of Unit 4, which is called Ratio Analysis. So this is from page 270 of your textbook onwards. Now, in chapter 6, we will be actually going through 5 different categories of ratios, whereby there are 11 ratio formula to actually look at and refer to as we do calculations and interpretations of ratios. In this chapter, it is very important to know how to calculate as well as to interpret each type of ratio. Now let's come and look at the first type of ratio. For liquidity ratio, this word liquidity means that the business is able to pay its debts as they are due for payment. This means that if a business is able to pay its debts when they're due, the business is highly liquid. But if they find it very difficult to pay their debts when they fall due, then the liquidity level is problematic and there might be some issues to be resolved. Now, there are 2 ratios that we can actually use to calculate the liquidity of the business. So the first one is the current ratio or working capital ratio, and the second one is quick asset ratio. Let's look at the first ratio. Current ratio or working capital ratio is a measure of the liability of a business to pay its short-term debt. It's very important to write the word short-term if you're asked to define this ratio or describe it. Now, short-term here means that the debt must be payable within 12 months or a year. So the definition of short-term is just like current assets or short-term assets within 12 months, within an accounting period. So the formula is given here, and you can also find this on your specifications booklet. Current assets divided by current liabilities times with 100. Now, if you look at an example in the next page, you can see that they would probably give you something like a balance sheet or a summary of accounts. In this case, you can already see the total current assets, 31,000. Total current liability would be 20,000. So when you want to calculate the current ratio for that period, it is easy because you already have the 2 figures. Just divide the 2 times with 100 and you get 155%. Now, this also means that if you're asked to describe this ratio, what it means that Wesco Limited had $1.55 of current assets available to pay every $1 of its current liabilities. Now, we must understand that when we talk about accounts receivable, it is a net amount where you must minus the allowance for doubtful debt, in a calculation of the current assets. Now, how do you interpret current ratio? If you're looking at a ratio of less than 100%, then the business may be either finding it difficult to pay short-term debts, or sometimes the industry where the business is running in collects money from sales very quickly. I'll give an example. So, when an airline industry sells their air tickets, usually the sales would require customers to pay first, right? And they will not fly it. So this money is collected very quickly before the service is rendered. So they may have a lot of current liabilities, and we call that unearned income. So this might be a reason why current ratio can be less than 100%, but it doesn't mean that the business is doing badly. It just means that the industry requires money to be collected from sales very quickly before the sales or service is rendered. For a current ratio between 100 to 200%, usually we can say that the business is able to pay its short-term debts. And a current ratio of more than 200% would indicate that the company should be able to comfortably pay the short-term debts, or sometimes it can be a problem because it means that there might be an excessive level of current assets. They may not be making best use of its resources to generate revenue. Now, the thing about interpretation is that this is a general guideline. So it is very important to understand that there are other ways to compare or interpret ratios as well. You can interpret ratios by comparing different companies in the same industry. So usually you would want the current ratio to be higher, but not too high. Or they can compare it with past years, and past years would mean that this year versus last year, or this year versus next year. And they can also compare it with the industry average. So generally we want the current ratio to be higher than whatever comparison base we use. Now, the second liquidity ratio is called the quick asset ratio. Now, the quick asset ratio is very similar to current ratio, but the difference is the short-term debt would be excluding any bank overdraft. overdraft. Yeah, and if you can see in the formula, when we look at the calculation, it is still current assets divided by current liabilities, but for current assets you must take out inventory and prepaid expenses if you have any included inside, and for current liabilities you must take out bank overdraft. Yeah, and the reasons are given here. So for inventory and prepaid expenses, they're left out because these two items usually have a very low level of liquidity compared to the other current assets. Yeah, so when we are talking about short-term debt, this short-term here is not within 1 year. It can be within a few days or a few weeks, something really short-term. Yeah, for inventory as well, because it is very difficult to sell quickly, prepaid expense, because you might be finding it difficult to recover money paid in advance. If let's say someone asks you to pay that debt tomorrow, you can't really recover this prepaid expense quickly. Yeah. Now, an example I'll use here, Steel Westco Limited. So you can see that the balance sheet is very similar, but when we want to calculate quick asset ratio, we cannot take the total current asset divided by total current liabilities straight away, because that is what current ratio is. For quick asset ratio, we can only take this amount, okay, the net accounts receivable, and also the accrued interest income. Yeah, we cannot include inventory and prepaid expense. For current liabilities, we can take these three, but not bank overdraft. Yeah, so the answer here is 84%. Yeah, you times with 100. Now this means you have 84 cents of highly liquid current assets available to pay $1 of all its current liability except for bank overdraft. How do you interpret this quick asset ratio? Generally, we can say that when you have 100% or more, then the business should be able to pay its very short-term debt. But if it is less than 100%, then in an emergency, they might find it very difficult to pay their short-term debt. And sometimes a retail company may have quick asset ratio of less than 100% because they have huge amounts of inventory. Yeah, and inventory makes up a large proportion of its current asset. Therefore, they have no choice but to endure lower quick asset ratio than other industries. But it doesn't mean that they're doing badly, because for retail companies, their inventory usually sells really fast.